All right, team. I'm going to jump straight into the revenue recognition principle. It starts off when a company agrees to perform a service or sell a product to a customer. It has a performance obligation. The revenue recognition principle requires that companies recognize revenue in the accounting period in which the performance obligation is satisfied. So basically, when we do the work, when we provide the service, that's when we record it. We have an example here to illustrate. Conrad Dry Cleaners performs cleaning services for $100 on June 30th. All right, now customers are not going to pay until the 5th of July. Under the revenue recognition principle, Conrad records revenue on June 30th. Why do they do that? That's because that's when they actually did the job. And that's kind of highlighted in blue. I kind of color coded the points, so that it's going to help us kind of keep pace. And we actually have the journal entry here. The journal entry is as follows. On July 30th is when we satisfy the performance obligation. And on July 5th, we record the money. Accounts receivable, 100, service revenue, 100. Remember, service revenue is always going to be credited because revenue increases with the credit. It's a little weird, but it does. And this is an asset receivable account that gets taken away by the cash. Moving along, I'm going to kind of go kind of quick through it because I don't want to do a 3-hour video. You guys may get tired, but I will if you need me to. We're going to move into the 5-step revenue recognition process. All right. Let's see. Here we got step 1. Identify the contract with the customers. Self-explanatory. What's what, what's where, what's who, who's who. Identify the separate performance obligations. All right, now every different task or service or product that you provide can be classified as different obligations. Here, the Sierra only has one obligation, and that's to provide tour guide services. I'm so glad that they gave it simple at the first one. All right, step 3, determine the transaction price, self-explanatory. We're going to be working with $1,500 worth of services. Step 4, allocate the transaction price to the separate performance obligations. Sierra only has one performance obligation. Okay, we already said that. Step 4, recognize revenue when each performance obligation is satisfied. Here it shows Sierra recognizes revenue of $1,500 for providing guide services to the Lewis family when it satisfies its performance obligation, the completion of the guide trip. This one was really self-explanatory. For $1,500, Sierra said, "Hey, we will provide you guide services." What was that date? Let me check that date. I don't think they gave us a date, but on the date in which they provide the services is when we recognize it. If they only do half the services rendered, we only recognize half at that time, and then we just create a liability. Let's move along to the expense recognition principle. Now, this is pretty much the matching principle. Here in yellow, we have, in recognizing expenses, a simple rule is followed. Let expenses follow the revenues. Thus, the expense recognition is tied to revenue recognition. This means that the salary expense that Conrad incurred in performing the cleaning services on June 30th, this is back from the earlier example, should be reported in the same period in which it recognizes the service revenue. Let's see which example they have. If Conrad does not pay the salary it incurs on June 30th until July, it will report, like I said, a liability called salaries and wages payable on its June 30th balance sheet. All right, the practice of expense recognition is referred to the expense recognition principle, which is often referred to as the matching principle. It dictates that efforts or expenses be recognized with results or revenues in the period in which the company makes the effort to generate those revenues. Same thing as other principle. Decision tools. This is important. The revenue recognition principle and the expense recognition principle help to ensure that companies report the correct amount of revenues and expenses in a given period. One will offset the other, make sure there's no overstatement or understatement in balances. All right, let's we've got a real life example here, investor insight. To be honest, we don't really have to go through that, but I would recommend really going and look at this case study. I've got some highlights there, but it'll just take too much time. All right, accrual basis versus cash basis is really simple, but it kind of gets a little tedious. Accrual basis means that the transactions that change a company's financial statements are recorded in the periods in which the events occur. For example, this means that companies recognize revenues when they perform the services, even if cash isn't received. Likewise, under the recognition principle, companies recognize expenses when incurred, the expense recognition principle, even if cash was not paid. Now let's look at the cash basis. Under cash basis, companies record revenue at the time that they receive cash. They record an expense at the time that they pay out cash. The cash basis seems appealing due to its simplicity and sometimes leads to fraud, but often produces misleading financial statements. For example, it fails to record revenue for a company that has performed services but has not been paid. As a result, the cash basis may reflect revenue in the period that a performance obligation is satisfied. I'm sorry, it may not. It may not reflect. Let me highlight here. We'll put that in blue just to stand out. All right. Cash basis accounting is not in accordance with the GAAP. If he ever true or falses us, remember, cash basis is not in accordance with GAAP. Let's move along to illustration 4.3. Am I recording still? I hope I'm recording. This better be recording. All right, illustration 4.3. It's pretty much an example of the cash basis for Fresh Color Paints. In 2001, Fresh Color Paints incurs and pays total expenses and salaries of $50,000. It bills the customer $80,000, but does not receive payment until 2022. It's perfect. Fresh Colors reports $80,000 of revenue in 2021 because that's when it performed the services. That's accrual. It performed the services, it recognized the 80,000. Performed the services, recognized the 80,000. The company matches expenses, 50,000 to the 80,000. Boom. And if we look down here in 2021, it is you'll see revenue, expense, net income, 30,000. The 30,000 of net income reported for 2021 indicates profitability for that period. Now let's go to cash. Down here, if Fresh Colors instead use a cash basis accounting, it will report $50,000 of expenses in 2021 and 80,000 of revenues in 2022. As shown in illustration 4.3, it will report a loss of $50,000 in 2021 and a net income of $80,000 in 2022. Why does this happen? Because under the cash basis, we expense when cash is paid, and we report revenue or recognize when cash is taken in. So in 2021, since we allowed our customer to not pay us until 2022, we reported an expense of $50,000. Therefore, it's recognized as a loss. Now, we know that we have an asset in a payable coming or a receivable coming. I'm sorry, it's a receivable. Since it's an asset, it's a receivable. Since we know we have that receivable coming, we're comfortable, but a bank would not be comfortable loaning that kind of money. It can be reversed to be in your benefit if the expenses were the other way around and the cash came first. But we'll talk about that later. All right, now we're going to move on to the need for adjusting entries. In order for revenues to be recorded in the period in which the performance obligations are satisfied and for expenses to be recognized in the period in which they are incurred, companies must make adjusting entries. Adjusting entries ensure that revenue recognition and expense recognition principles are followed. If you see here, the trial balance may not be accurate if we do not adjust our balances. So let's give a few scenarios of why this may be true. Some events are not recorded daily because it's not efficient to do so. Examples are use of supplies and the earning of wages by its employees. Some costs are not recorded during the accounting period because these costs expire with the passage of time rather than as a result of recurring daily transactions. Examples are charges related to the use of buildings and equipment, rent, and insurance. Some items may be unrecorded. An example is a utility service bill that will not be received until the next accounting period. Adjusting entries are required every time a company prepares financial statements. The company analyzes each account in the trial balance to determine whether it is complete and up to date for financial statement purposes. Every adjusting entry will include one income statement and one balance sheet account. All right, now we're going to move into the types of adjusting entries. Adjusting entries are classified as either deferrals or accruals. Deferrals, prepaid expenses, unearned revenues, accrued revenues, accrued expenses. All right, these are just examples. We can refer to those later and on the Zoom call. We're going to move to learning objective 2. Adjusting entries for deferrals. To defer means to postpone or delay. Deferrals are costs or revenues that are recognized at a date later than the point when the cash was originally exchanged. Let's give the examples. The two types of deferrals are paid expenses and unearned revenues. The two types of deferrals are prepaid expenses and unearned revenues. Prepaid expenses. Companies record payments of expenses that will benefit more than one accounting period as assets. These prepaid expenses or prepayments are expenses paid in cash before they are used or consumed. When the expenses are prepaid, an asset account is increased to show the service or benefit the company will receive in the future. Examples of common prepayments are insurance, supplies, advertising, and rent. In addition, companies make prepayments when they purchase buildings and equipment. Prepaid expenses are costs that expire either with the passage of time or through use. Accordingly, companies postpone the recognition of such cost expirations until they prepare financial statements. All right, this is important right here. Prior to adjustments, assets are overstated and expenses are understated. That's really important. Remember that because it'll be like, it'll throw us off. Therefore, an adjusting entry for prepaid expenses results in an increase to an expense account and a decrease to an asset account. Adjusting entries for prepaid expenses. Oh, I'm sorry, no. Supplies. The purchase of supplies such as paper and envelopes results in an increase or debit to an asset account. Companies recognize supplies expense at the end of the accounting period. The company counts the remaining supplies at the end of the accounting period, and the difference between the unadjusted balance in the supplies account and the actual cost of the supplies on hand represents the supplies used and expense for that period. Sierra Corporation purchased supplies costing $2,500 on October 5th. Sierra recorded the purchase by increasing or debiting the supplies at the asset supplies. The account shows a balance of $2,500 in the October 31st trial balance. A physical count of the inventory at the close of business on October 31st reveals that 1,000 of supplies are still on hand. All right, cool. So we use some supplies. Thus, the cost of the supplies used is $1,500, or the difference. This use of supplies decreases an asset. It also decreases stockholders' equity by increasing an expense account. Still pretty. All right. To kind of understand what I was saying, this is very important. Kind of memorize this chart. All right. After adjustment, the asset account supply shows a balance of 1,000, which is equal to the cost of supplies on hand at the statement date. In addition, supplies expense shows a balance of $1,500, which is equal to the cost of supplies used in October. So supplies expense is going to show a balance of $1,500 because that is the actual cost of supplies. If Sierra does not make this adjusting entry, October expenses will be understated by $1,500. Moreover, both assets and stockholders' equity will be overstated by $1,500. So what this means is, if somebody says, hey, we didn't use these supplies, or they forget to mark it down, then the assets and stockholders' equity can be overstated. And if anybody wanted to be a little crooked, they can say, hey, we have this many supplies, and they record that. Boom, the company's assets actually look a little better on the sheet. So it's very, very important. Here's a helpful hint. Due to their nature, adjusting entries have no effect on cash flows. As a result, we do not show the cash flow effects in these illustrations. Not 100% sure why they decided to go with that. But yeah. All right, let's talk about everybody's favorite thing to pay for, insurance. Companies purchase insurance to protect themselves from losses due to fire, theft, and unforeseen events. Insurance must be paid in advance, often for multiple months. The cost of the insurance or premiums paid in advance is recorded as an increase in the asset account, prepaid insurance. At the financial statement date, companies increase or debit insurance expense and decrease or credit prepaid insurance for the cost of insurance that is expired during the period. On October 4th, Sierra Corporation paid $600. Yes, they use an even number. They paid $600 for 1 year fire insurance policy. Coverage began on October 1st. Sierra recorded the payment by increasing or debiting prepaid insurance. This account shows a balance of $600 on the October 31st trial balance. Insurance of $50 or $600 divided by the year. The cost is $50, so it's $600 divided by 12. Expires each month. The expiration of prepaid insurance decreases an asset, which is prepaid insurance. It also decreases stockholders' equity by increasing an expense account, insurance expense. As shown in illustration 4.8, the asset prepaid insurance shows a balance of $550, which represents the unexpired cost of the remaining 11 months coverage. At the same time, the balance in the insurance expense equals the insurance cost that expired in October. If Sierra does not make this adjustment, the October expenses are understated by $50 and the net income is overstated. Moreover, both assets and stockholders' equity will be overstated by $50 on the October 31st balance sheet. All right, let's talk about depreciation. But before we move on, remember, pay close attention to this. These little blurbs are graphics. Adjustment for insurance. No, why do I keep doing that? Let's move on to depreciation. Depreciation. All right, this is very, very confusing to laymen, so I would pay close attention to the tricky foolishness with depreciation. A company typically owns a variety of assets that have long lives, such as buildings, equipment, and motor vehicles. The period of service is referred to as the useful life of the asset. Because a building is expected to be of service for so many years, it is recorded as an asset rather than an expense on the date it's acquired. So basically they're saying this building, we're going to own it for 50 years, so it's definitely an asset and we're going to get use out of it. It's very important to also remember that companies record assets at cost, or what's known as the historical cost principle. To follow the expense recognition principle, companies allocate a portion of this cost as an expense during each period of that asset's useful life. That is called depreciation. So depreciation is the process of allocating the cost of an asset to expense. To expense over its useful life. All right, we're going to talk about the need for adjustment. The acquisition of long-lived assets is essentially a long-term prepayment for the use of an asset. An adjusting entry for depreciation is needed to recognize the cost that has been used during the period and to report the unused cost at the end of the period. One very important point to understand, depreciation is an allocation concept, not a valuation concept. That is, depreciation allocates an asset's cost to the periods in which it is used. Depreciation does not attempt to report the actual change in the value of the asset. That's the tricky part right there that I was talking about. All right, we're going back to Sierra Corporation in illustration 4.9. For Sierra Corporation, assume that the depreciation on the equipment is $480 a year or $40 per month. As shown in illustration 4.9, rather than decrease or credit the asset directly, Sierra instead credits accumulated depreciation for equipment. Accumulated depreciation is called a contra asset account. Definitely look this up on the side. Contra asset account. These get a little tricky. Such an account is offset against an asset account on the balance sheet. Thus, the accumulated depreciation equipment account offsets equipment. This account keeps track of the total amount of depreciation expense taken over the life of the asset. All right, here's an adjustment for the depreciation under 4.9. All right, here's a helpful hint. All contra accounts have increases, decreases, and normal balances, opposite to the account in which they relate. That is where things get tricky. So sorry. So sorry. That's where things get tricky. Statement presentation. As noted above, accumulated depreciation equipment is a contra asset account. It is offset against equipment. The normal balance of a contra asset account is a credit. A theoretical alternative to using a contra asset account would be to decrease or credit the asset by the amount of depreciation in each period. But using the contra asset is preferable for a simple reason. It discloses both the original cost of the equipment and the total cost that has expired to date. Thus, in the balance sheet, Sierra deducts accumulated depreciation from the related asset account as shown in illustration 4.10. Boom. All right, this is pretty important. Book value is the difference between the cost of any depreciable asset and its related accumulated depreciation. What the fuck? How? The book value and the fair value of the asset are generally two different values. As noted earlier, the purpose of depreciation is not valuation, but a means of allocation. Alternative terminology, book value is also known as carrying value. I think that's like a regional thing. You never know. All right, depreciation expense identifies the portion of the asset's cost that expired during the period. Without this adjusting entry, total assets, total stockholders' equity, and net income are overstated by $40, and the depreciation expense is understated by $40. All right, illustration 4.11 is probably going to be one of my favorite ones. I would definitely memorize pretty much every illustration we had, memorize it so far. Unearned revenues. This is always fun. Companies record cash received before services are performed by increasing or crediting a liability account called unearned revenues. In other words, the company has a performance obligation. Remember earlier, we talked about the different performance obligations and their breakdowns. In other words, the company has a performance obligation to transfer a service to one of its customers. Items like rent, magazine subscriptions, and customer deposits for future service may result in unearned revenues. Unearned revenues are the opposite of prepaid expenses. And indeed, unearned revenue on the books of one company is likely to be a prepaid expense on the books of the company that has made advance payment. When a company receives payment for services to be performed in the future accounting period, it increases credits and increases or credits an unearned revenue account. Unearned revenue is a liability account used to recognize the obligation that exists. The company subsequently recognizes revenues when it performs a service. During the accounting period, it is not practical to make daily entries as the company performs services. Instead, the company delays recognition of revenue until the adjustment process. Because in other words, I just be going back and forth and it's driving me crazy, and that will cause a big error. So let's just wait till the end. Prior to adjustment, this is important, and you probably want to go back. I'm sure there's a table on it at the end. Prior to adjustment, liabilities are typically overstated and revenues are understated. Therefore, as shown in illustration 4.12, the adjusting entry for unearned revenues results in a decrease or a debit to a liability account and an increase to the credit account. I'm sorry, an increase to the revenue account. Sierra Corporation received $1,200 on October 2nd from Knox for guide services for multi-day trips expected to be completed by December 31st. Sierra credited the payment to unearned revenue. This liability account shows a balance of $1,200 in the October 31st trial balance. From an evaluation of the service Sierra performed for Knox during October, the company determines that it should be recognized $400 of the revenue. The liability account is therefore decreased and stockholders' equity is increased. As shown in illustration 4.13, the liability unearned service revenues now shows a balance of $800. That amount represents the remaining guide services Sierra is obligated to perform in the future. Service revenue shows a total of $10,400. Without this adjustment, revenues and net income are understated by $400 in the income statement. Moreover, liabilities are overstated and stockholders' equity is understated. Where's my water? I need my water. All right, this is just a chart, a beautiful chart. This is a very interesting little case study on gift cards. Definitely go and read those things on gift cards. It's important. These are case studies and solutions, or do-its, as they like to call them. They like to call them do-its. Do-it. All right, so now we're going to go into adjusting entries for accruals. All right, I had paused for a second. I'm back in effect. Now we're going to jump into adjusting for accruals. The second category of adjusting entries is accruals. The revenue account and the related asset account, or the expense account and the related liability account, are understated prior to accrual adjustment. Thus, the adjusting entry for accruals will increase both a balance sheet and an income statement. Accrued revenues. Revenues for services performed but not yet recorded are accrued revenues. Accrued revenues may accumulate or accrue with the passing of time, as in the case of interest revenue. These are unrecorded because the earning of interest does not involve daily transactions. Company do not record interest revenue on a daily basis because it is often impractical to do so. Accrued revenues also may result from services that have been performed but not yet billed nor collected, as in the case of commissions and fees. Man, I feel like I'm reading out loud. When I was a kid, I was terrible at it, but I always get nervous. All right. This guy right here and this lady right here, they're gonna help us. An adjusting entry records the receivable that exists at the balance sheet date and the revenue for services performed during the period. Prior to adjustment, both assets and revenues are understated. As shown in illustration 4.15, an adjusting entry for accrued revenues results in an increase to an asset account and an increase to a revenue account. In October, Sierra performed guide services worth $200 that were not billed to clients on or before October 31st. Because these services were not billed, they were not recorded. The accrual of unrecorded service revenue increases an asset account, accounts receivable. It also increases stockholders' equity by increasing a revenue account, service revenue, as shown in illustration 4.16. The accounts receivable shows that clients owe Sierra $200 at the balance sheet date. The balance of $10,600 in service revenue represents the total revenue for services Sierra performed during the month. That's $10,400 plus $200. Without these adjusting entries, assets and stockholders' equity on the balance sheet and revenues and net income on the income statement are understated. On November 10th, Sierra receives cash of $200 for the services performed in October and makes the following entry. Debits cash for $200. Credits account receivable. Illustration 4.17, very important. Memorize it, learn it, love it. All right, we're almost done here, people. We're almost done. Accrued expenses. Expenses incurred but not yet paid or recorded at the statement date are called accrued expenses. Interest, taxes, utilities, and salaries are common examples of accrued expenses. Companies make adjustments for accrued expenses to record the obligations that exist at the balance sheet date and to recognize expenses that apply to the current accounting period. Prior to adjustment, both liabilities and expenses are understated. Therefore, As shown in illustration 418, an adjusting entry for accrued expenses results in an increase to an expense account and an increase or credit to a liability account. This is an interesting ethics note. Mic check, 1, 2, mic check. Okay. I'm be honest with you. This right here, too much math. We're gonna have to do this one on a Zoom call. We'll do that as soon as y'all call me or ask me. It's all good. That one, too much math to do without having questions and feedback. Same, the principles are the same. These we really need to do in Zoom. All right. Let me see, accrued salaries. Yeah, we'll do that in Zoom. All right, this chart right here, learn it, love it. It's a huge summary. These are all notes. The adjusted trial balance and closing entries. All right. This is everything we've been waiting on, minus the math stuff that we said we'd go over later. The adjusted trial balance and closing entries. After a company has journalized and posted all adjusting entries, it prepares another balance, and it prepares another trial balance from the ledgers. The trial balance is called an adjusted trial balance. It shows the balances of all accounts and those adjusted at the end of the accounting period. The purpose of the adjusted trial balance is to prove the equality of the total debit balances and the total credit balances after all adjustments. Because the accounts contain all the data needed for financial statements, the adjusted trial balance is the primary basis for the preparation of the financial statement. There we go. Preparing financial statements. Companies can prepare financial statements directly from an adjusted trial balance. And here it goes right there. This is all just factual stuff. Not really too.